You can use the JOLTS to forecast a large portion of what inflation is going to be like. JOLTS is a very cool piece of information, one of the most important data points that a lot of traders don't really think about. They kind of overlook it. And it's because we're so used to staring at like FOMC and CPI. But did you know, I used to use the JOLTS to predict what the Fed was going to do. And this is how you can kind of take a stab at that. So during COVID, right, everybody got laid off. And so JOLTS is a way to measure what's going on in the job market, right? And when everybody got laid off in COVID, very few people were able to go back to work. And the ones that did wanted a ridiculous salary for the risk they were taking. And so salaries went way up, right? Everyone needs a truck driver. And the one guy that's willing to drive during COVID demanded like 5 times his salary, and the demand was there. And companies were like, okay, I guess we'll pay it. And everybody in that situation was getting paid a whole lot to work from home. And then all of a sudden prices of stuff went up because there was a shortage on materials. House prices went up, prices of everything went up. And so salaries had to go up even more so people could afford to pay for that. And the GDP wasn't high enough to flood the market with supplied goods to bring prices down. So we had inflation based on that mechanism. It's called cost push inflation, right? When the cost of labor and the cost of raw materials that go into something make the price of it really high. Shortages of like home building materials made house prices go up, right? And that's the mechanism of COVID, creating that kind of cost push inflation. Another type of inflation comes from hypereconomic activity, right? You have a company that's doing very well, another company is doing very well, and you want to expand. So you're going to raise your prices a little bit to cover the overhead of R&D and future production lines. And so prices go up a little bit. And then that trickles down to everyone else's prices going up a little bit because they can compete with you. And all of a sudden, everybody's employees want a little bit more money. And then that's your 2% inflation a year through economic growth. That's normal inflation. That type of inflation the Fed can control pretty easily by raising the federal funds rate. That controls where deposits can go from other participating banks to basically incentivize or de-incentivize them lending money to you so you can go buy shit on credit. But why are the JOLTS important, especially in that level of cost push inflation where that's causing a lot of stuff happening? Let's tell you what a JOLT is. A JOLT is defined by the Bureau of Labor and Statistics as a job opening that is an available job at a company that exists and there are workers available for that job. It's not like, hey, there's an open job in the middle of Siberia, an oil rig, and nobody wants to go there. It doesn't count. There's a job that's available and there's a worker that can fill that job. So there's no logistical bottleneck between somebody finding the job they want. It's like a doctor position is needed and there's a doctor available. So essentially, JOLTS is like the job market of supply and demand with no bottlenecks. The worker lives too far away or not the right kind of worker, or the worker can't start for a month. So JOLTS can go up and go down, and both up and down are both good and bad in different circumstances. And the example in COVID,